Welcome back, traders. In today's video, we are going to break down a clean and high-probability sell setup on gold using smart money concepts on the 1-hour time frame. I will take you through the complete sequence, starting from the break of structure, moving into the liquidity sweep, identifying the correct order block, spotting the inducement, mapping out the sell-side liquidity target, and finally, entering the sell trade using institutional price delivery. This breakdown is very simple, very repeatable, and it shows how gold respects smart money concepts beautifully. So let's go step by step and study exactly how this setup formed. Before marking any zones, we first look at the overall market context. We always want to understand who's in control of the market, buyers or sellers. In this case, gold on the 1-hour time frame is showing a clear bearish environment. The market has been forming lower highs and lower lows. Every upward move is simply a retracement, and every downward push continues the main trend. This is important because it gives us our directional bias. When the trend is bearish on the 1-hour time frame, we are not interested in buying. Instead, we wait for price to come back to a premium level where institutional sellers previously entered the market. Only then do we prepare for a new sell opportunity. The next key event is the break of structure. Look at the point where price pushes down and closes below the previous 1-hour swing low. This downside break tells us that sellers have taken control once again. A break of structure confirms that the previous demand level has failed and that price is now ready to move toward new, lower prices. This break is the foundation of the entire setup. Without a break of structure, we do not look for a retracement entry. But once the break is confirmed, we expect price to pull back into a premium area, and that is where we want to prepare for our sell trade. After the break of structure, something very interesting happens. Price retraces upward and forms a liquidity sweep. You can see a candle wick that moves above the previous swing high. That wick is extremely important. It shows that the market intentionally grabbed the liquidity resting above that high. Retail traders often place stop losses above obvious highs, and institutions use those stop losses as liquidity to enter their large sell positions. So this wick is not random. It is a stop hunt designed to collect liquidity before the market continues lower. A liquidity sweep above a broken structure is one of the strongest signs that the market is preparing to deliver a move back in the direction of the trend. Now that the liquidity sweep has occurred, we identify the order block. The order block is the last bullish candle or small bullish candle cluster before the strong bearish move that caused the break of structure. That candle represents the area where institutional sellers entered their positions. On the chart, I have marked this candle zone clearly. This becomes our supply zone. We expect price to return to this exact area, mitigate the remaining orders, and then reject downward again. The order block is the most important part of the setup. It gives us a precise location where we look for a sell entry. When price returns to it, we watch for confirmation inside the zone. Just before price reaches the order block, we see a short, bullish rally. This small upward push is known as inducement. Inducement is a very strategic move by the market. It encourages retail traders to buy at the wrong time. Many traders will see that small bullish move and assume the market is reversing upward, so they enter buy trades with stop losses above the order block. This creates fresh liquidity, exactly what institutions need to execute their large sell orders. So, inducement is not random. It is part of the liquidity engineering process. It creates additional stop losses and buy-side orders that can be used as liquidity once price taps into the order block. Now that we know where to enter, we also need a clear target. The sell-side liquidity is the area where equal lows or previous swing lows are located. These levels hold a large concentration of stop losses belonging to retail buyers. Institutions target these lows because those stops provide the liquidity needed to close their positions in profit. So, we mark the cluster of lows below the current price as our main take-profit level. This sell-side liquidity becomes our destination for the trade. Here is how the actual entry is taken. Price returns to the order block. Inside that zone, we wait for a rejection, ideally a bearish engulfing candle, a long upper wick, or a strong close away from the zone. Once the rejection is confirmed, we take our sell entry. Our stop loss is placed above the highest point of the liquidity sweep. This protects the trade and ensures that if price breaks above that level, the setup is invalid. Our take-profit level is the sell-side liquidity we marked earlier. As price moves downward, we can secure partial profits at intermediate lows and hold the remainder until the final target is reached. If you want more deep smart money concepts breakdowns and want to master institutional trading models, make sure you follow Discount Trader for more complete step-by-step explanations. Thank you for watching, and I will see you in the next video.